Today, folks, I acted upon the holy sin, at least so dividend investors might proclaim, and that is hitting the sell button. I sold some Google stock, and we should talk about it. I mean, it was a measly 22 shares as it reaches my price targets, and these are the allotted shares that I planned on selling within this range. And even after selling those shares, my Google position is still over 10% of my entire portfolio. I want to talk about what I did with those shares, answer some of your comments from yesterday, and take a look at one of the craziest AI stories I've ever seen. One of the largest market cap jumps in history, which was Oracle jumping 40%, hitting almost $1 trillion market cap today, making the CEO the richest man in the world. So if you're on a path to financial independence, if you damn well one day want to retire early, join me, hit that subscribe button, folks, because Google stock is trading in the range that I was expecting to come this year, calling a lot of good facts out that were being misrepresented through fear mongering when it came to large language models destroying search, and of course the court case that was largely over exaggerated. I said the stock should be trading around a 25 times multiple, should be trading at least somewhere between, my fair valuation was 240 to 250 a share, but I think in this current bull market, it's fairly valued somewhere between 250 and 300 if it's trading at similar valuations to say that of Microsoft or even that of Meta that's closer to a 27 times multiple. We're right now at about a 26. And the way I'm going about selling the shares is the mistake I made in the past is I always used to be in a very big rush to get out real quick, but because I'm very bullish long-term on the company and I just want the size position to be no more than 5% of my portfolio to be at a healthier position size for the risk, I'm just slowly, weaning the position down. It'll probably take me a few weeks, maybe even longer than a month. I'm not in a rush to get out of this, but hey, I'm at the 240 range. I'm just going to slowly start taking the capital and reallocating it to the two stocks I mentioned within my tax-free savings account. I did buy more S&P today. Was I excited buying it at all-time highs? No, but with the 5,000 US in profit I took on Google, I just immediately put it into the S&P because I'm trying to get about $100,000 worth of the CAD value of VOO in my TFSA. I've told you my short-term plans are get 100,000 of VOO in my TFSA, my RSP, and my corporate account. I'm there pretty much. I've checked all those boxes. The next step is to get $100,000 in VDY. I will use the remainder of the Google profits I'm going to sell in the coming weeks and months to put into VDY, at which I'll keep the rest of my Google shares in the corporate account and just go long. And that'll be my short-term planning. And I think I'm right on track if the market remains as bullish to get there in a way I never would have anticipated, because even with the rallies we're seeing in today's market, I'm very closely knocking to $500,000 within my stock portfolio alone. And I just can't get over, guys, every day logging in. And I'm like, this is just ridiculous, right? But these are bull markets. And in my video yesterday, some of you were pointing out as a beginner, I've been following and slowly investing in VDY, but I'm wondering why VDY over something like ENB, which is Enbridge, or a bank stock that pays a higher dividend. Again, this equates to the fact I'm not purely a dividend investor. I'm a total return investor. I think dividends and stock gains are roughly the same thing, equating to total returns, but I get a balanced approach of whether you want more income or you want more growth, depending on where you're at in your investing career. And I don't want the risk necessarily of individual stocks, because you have to pay attention to them, you have to monitor them, but through a market cap weighted system over long periods of time, like 10, 20, 30 plus years, the dividend kings of Canada that start to underperform will de-weight their way naturally out of this ETF, removing my management and my own stupidity and how I personally might feel about the company, and obviously upperweighting the better performers. I don't know why people have a problem concentrating. Everyone's complaining about the S&P being over-concentrated, but that is the reality in the ebb and flow of market cap weighted ETFs. When sectors start to outperform, they will become overweight. And in cyclical periods where those start to underperform, other sectors will make up for that lack of performance. I mean, yes, you could get a shock event where tech corrects majorly in the S&P, but again, over long periods of time, this is a proven mechanism of action that removes the emotional ignorance that most people tend to inflict through biases on the stocks that they're picking. So I like Enbridge. I like the banks. Over time, I started collecting all of these Canadian stocks, and I just said to myself, why am I buying all of these? It's insane. To manage 20, 30 Canadian stocks, why not just find an ETF that encapsulates, my beliefs within investing that holds these companies the way I'd want to hold them? And I'm fine having these crazy exposures to the Canadian banks because it's 50% of this ETF is just the financial sector, mostly upper weighting the banks, which I would be fine holding individually. Enbridge, top weighted holding in here, guys. I love all the stocks in here. I would own all of them. I also get TELUS, some of the lower half in here, some gold companies, sectors that are crushing it, Canadian Natural Resources. You can't go wrong, for me, not for you, not as financial advice, just as opinions of my own, with an ETF like VDY, because again, encapsulating, the total returns since inception. This is annualized 10.34%. That is exceptional. Within the last 5 years, the annual rate of return has been 17%, and just in the last year has been 20%. This ETF absolutely has crushed, and I think it's a good way of bumping up some income, giving me a monthly yield off the stocks I love, and it comes with a very low expense ratio of 0.2%. It's a balanced approach for me of income and growth. And it, again, gives me that great exposure. So when I look at my portfolio overall, like I said, I'm about to reach my short-term goals. The other short-term goal I have is just to pay off the mortgage. Actually, today or tomorrow, I'm going to do another 15% allotted payment. I'm very happy to do so and get my mortgage paid down as quickly as humanly possible while my portfolio is extended in this bull market. It's kind of a way of alleviating some of that concern that if a crash comes, hey, at least I'm putting a lot of cash to the mortgage instead of just overthrowing it in the market. To each their own. Obviously, the returns have been better if you just stuck to, not paying your mortgage down and keeping it in the market. But for my own mental sanity and for the long-term fortitude of my plan, I think I'd feel better knowing that if the market tanked or corrected majorly, that I did allocate quite a bit toward the mortgage in the short term. But who knows? That's just something that makes me morally sleep great at night. But regardless, guys, it is a fascinating time to be alive, and especially with companies like Oracle. I can't get over the jump. It is rare you see mega cap companies do these kind of moves. I mean, the only exception might have been Nvidia, but on a single day move like this, guys, it was up 40% to almost $1 trillion valuation, making this guy here. I've never looked into Oracle all that much, but I'll show you some of the earnings and why the stock's up. But Larry Ellison just completely became the richest man in the world, which is, again, nothing short of astonishing. And when I looked at the earnings, I wasn't that impressed. It's not the earnings that are driving the growth. Of course, it's future expectations. But total revenue, guys, was materially up, really only 12%, which is great, but most of it's being driven by cloud. You can see they're losing money on software. Hardware is flat. Services are up low single digits. Again, Google's earnings and revenue looked way more impressive. But what's driving this growth, and again, you see a 28% jump in cloud revenue from 5.6 billion to 7.1 billion. And I will remind you, Google's cloud and cloud services what's driving the future growth, because again, this is, I guess, where AI is living, and this is just the potential for high margin growth across all the mega cap tech companies. But look at cloud going from 10 billion to 13.6. Google has a higher cloud revenue, and the growth is still nothing short of astonishing, but it's going to get crazy for Oracle because they are anticipating cloud revenue to jump to 144 billion by 2030. And this is based on backlog and contract growth, but they expect cloud infrastructure revenue to grow 77% to 18 billion this fiscal year, and then an increase to 32 billion, 73 billion, and then 114 billion and 144 billion over the subsequent 4 years. So I don't know. The underlying contracts driving this are insane. And I wonder if Amazon or Google or any of these other companies are getting similar contract interest because this is disgusting. And I mean, this would well put them above many of the mega cap cloud companies out there. And just reading a little bit deeper into this, we signed 4 multi-billion-dollar contracts with 3 different customers in Q1. And he said this has basically resulted in the company's contract backlog increasing 359% to 455 billion in the first quarter. The executive added that the company expects to sign up to several additional multi-billion-dollar customers, and for its RPO to exceed $500 billion. We have signed significant cloud contracts with the who's who of AI, including OpenAI, xAI, Meta, and many others. Guys, this is absolutely unreal. The software giant said that it is capital expenditure will jump to roughly 35 billion in 2026, up from its previous outlook of around 25 billion for the year. I don't know. You could read through this, but yeah, guys, if you don't think AI is real, man, and you can kind of get under the wing of the mega caps out here like Nvidia has, companies like Meta, Google, Amazon that have massive cash flow to spend on this. I mean, again, nothing short of just jaw-droppingly astonishing, crazy, outlook on the company. And I think this is only more bullish and continues to iterate the bull market that we are in. And again, I wish I was smart enough to know what's going on with Oracle, but regardless, I think this is only going to benefit companies further like Google, Meta, you name it. It's just solidifying the reality of what is coming, regardless of whether you believe it is a bubble, which I think it is a secular bubble for some companies out there. But in some aspects, we're going to start seeing massive revenue and margin expansion, and we are already with companies like Google. So I want to pass the question off to you. Are you guys buying these? Where do you think the future is going? I want that exposure regardless, which is why I'm so concentrated in the S&P 500. But I will pass that question off to you. I'd love to know what you think in that comment section below.